Hey everybody, it's Darren Wurz here with Wurz Financial Services, certified financial planner, author of The Lawyer Millionaire coming out this year from the American Bar Association, and podcast host of the Lawyer Millionaire podcast, also coming soon. Today I want to talk about something that everybody seems to be talking about these days, and that is inflation. You may have noticed that prices seem to be going up, and there's a lot of theories about why that is and how long that may last. Well, why exactly is inflation going up? What does it mean? And will it last? And what, if anything, can you do about it? First of all, if you might not know anything about inflation, inflation is just the tendency of prices to rise over time. And this is a pretty normal thing, but we're noticing it now because it's happening a little bit faster than it has over the in the recent past. We've become accustomed over the last 10 years or so, maybe 20 years, to inflation that's somewhere around maybe 2%, maybe a little bit less. It has lagged in recent years. The Federal Reserve has set a target of 2% inflation that they've been trying to achieve. And for many, many years, we struggled with really low inflation, and the Federal Reserve was trying to do things to try to spur economic growth and push inflation up a little bit. In Europe, for example, they've struggled with low inflation for years and years and years. Well, suddenly we find ourselves in a situation where inflation is running a lot hotter than it has in recent years. And so actually the most recent read so there's a couple different ways to measure inflation. One is CPI, that's the Consumer Price Index. And basically it's a data set that's put together by the government where they measure different goods and services and see how those are changing over time. And the short term for that is CPI. So CPI, the last read for the annual CPI, I think was 7.5%, which is extraordinary. That's the fastest year-over-year change that we've seen since the 1980s. So inflation is hot. It's running really hot. The last time we had a serious problem with inflation was the 1970s. It's been a really, really long time since we've had a big problem with inflation like that. And so people are concerned. They're concerned about, well, are we going to see 1970s style inflation again? And the reason people are so concerned about this is because last time we had this kind of inflation, the way that the government, or the Federal Reserve, tries to bring inflation down is by raising interest rates and tightening the money supply. And usually that means restricting economic activity. And so people are concerned about what that might mean for the economy and what that might mean for the stock market also. So anyway, what causes inflation? Well, inflation is a phenomenon that's related to the money supply. So if you took a basic economics class, you may have learned about supply and demand, right? When the supply of something increases, its value goes down. And basically, that's what the Federal Reserve has done during the pandemic. They have expanded the supply of money by lowering interest rates and by something called quantitative easing. Okay, that's a big fancy word that just means they go out and they buy treasury bonds and mortgage bonds. So, and by doing that, they're actually basically artificially creating money, digitally creating money, they call it. So that's how they create money. They basically just flood the system with extra liquidity. And this helps to stabilize markets during periods of stress like the pandemic. And so that's why they did that. Well, now, there are consequences to expanding the money supply. You expand the supply of money, the value of money, the value of the dollar goes down, and the price of everything goes up. Then there's some other things that might be exacerbating this problem that people are talking about in the news. Supply chain disruptions. There's trouble getting goods where they need to go just because of the pandemic and everything. And that's kind of still percolating in certain parts of the world. and creating challenges there. Also, just the return to normal, as things open back up and people are buying, that creates economic activity, it creates demand, and that demand means inflation. So that's also in effect. And then there's labor shortages going on. So companies are having to pay to find employees. They're having to pay their employees more. And so expenses on companies are going up, and they are passing on those expenses to you, the consumer. So the question everyone's thinking about right now, is this going to last? Because a spike in inflation, real quickly might not be a bad problem. But if this turns into more of a permanent trend, there's going to be some issues. Wage inflation needs to keep up, otherwise people are not going to be able to afford things. And then, of course, that has an effect on the economy and, of course, an effect on the stock market. Another big thing is stocks are really richly valued right now, especially tech stocks. They saw a really big increase in value over the last few years. And there's a equation for how these tech stocks are valued that's really dependent on the market, the risk-free rate of return, they call it, which is basically the yield on treasuries. And so if yields start to go up, basically a lot of investors start to reprice securities, or the market, the theory is anyway, the market starts to reprice security stocks. And a lot of these really highly valued tech stocks could see a decline in value as they get repriced. And so that's something that a lot of people are really concerned about too. So, and this is kind of foreign territory. We haven't seen anything like this since the 1970s and 1980s. So obviously a lot of people are understandably nervous. Some of these things are temporary. Labor shortages, supply chain disruptions, the reopening, a lot of that phenomena is temporary. However, the increase in money supply, that's more of a long-term, more of an intermediate to long-term thing. And the bad news is the Fed is still increasing the money supply because they are still continuing with their asset purchases. The only thing that they've committed to at this point is slowing down that stimulus, slowing down that purchasing of treasury bonds and things like that. But for the time being, they're still expanding. They're still putting money out there. They're still expanding the money supply. And so that hasn't stopped yet, but they have talked about planning to slow that down and eventually stop that. So some of these things could last. And so the Fed may have to take certain actions to combat inflation. And what are those actions? Raising interest rates and reducing their balance sheet, or basically shrinking the money supply. So what they would do is sell back some of those treasuries and things that they bought into the market. And by doing that, they're basically taking money out of the market. And that is shrinking the money supply, essentially. So what effect is this going to have in the market? Well, if interest rates go up, and many people believe they might, if economic activity continues to be robust and inflation continues to be strong, bonds are going to suffer. And so that portion of your portfolio may have some trouble. Highly valued growth stocks, like really small tech stocks, might experience some high volatility. We're already seeing a lot of that. So those are some things you can expect. But anyway, this is something that is happening. It's just what's going on right now. As always, you want to try and you need to have an investment strategy that's going to be able to deal with these things. If you're investing on your own, you want to make sure that your portfolio is well diversified and balanced, that it isn't over concentrated in any one particular area. If you haven't made any adjustments to your portfolio over the last couple of years, it might have become too concentrated in certain areas. But if you're looking for someone who can help you navigate these challenges and put together an investment strategy that is able to not only protect against some of these risks, but maybe take advantage of some opportunities that this kind of an environment creates, give me a call. We specialize in providing our clients with active investment strategies that are rules-based. They're based on very specific quantitative rules. They're all based on academic research, and we can go back in time and test them out and see how they did during different time periods, including time periods similar to this one that we're in right now. So that's all for now. Just a little bit on inflation. I'm Darren Wurz, certified financial planner with Wurz Financial Services. If you want to learn more, check me out at wurzfinancialservices.com. If you have questions about your portfolio or you want to talk a little bit about inflation or anything, feel free to give me a call at 859-291-9879. Thanks for listening, and hope you have a great day.